Well, hello everybody. Today we're going to learn these two very important words, debits and credits, which we use in specialized ways within our accounting system to describe financial information. Now let's start back with the old balance sheet that we talked about before. You'll remember, assets on the left side, liabilities and equity on the right side, right? And you'll also remember that the total of the assets is always equal to the total of the liabilities and the equity. Now, going back to the Middle Ages when the accounting system was evolving, what they did was they decided to call the left side debits. So assets are debits. If you have an asset, that's a debit. And the right side, they decided to call it credits. So if you have a liability or an equity, that's a credit. Now, that's easy to remember. Let's take it one step further. Let's say this. When an asset goes up, we're going to call that a debit. And when a liability or an equity goes up, we're going to call that a credit. Okay, let's take it another step further now. When an asset goes down, we're going to call that the opposite of a debit, which is what? That's a credit. And similarly, if a liability or an equity goes down, we're going to call that the opposite of a credit, which is a debit. So that is the basic rules for debits and credits. Easy to remember, right? Let me just add a couple of more things. Let me talk about revenues. Now remember, revenues is when you make earnings by selling goods or services. Now, when you make revenues, when you earn revenues, how does that affect your equity? Equity goes up, right? Now, when equity goes up, what do we have? Credits. Okay, so just remember, revenues are always credits, okay? Now, let's talk about expenses. Expenses are the costs you incur doing your business. How do expenses affect equity? They make it go down. So, when equity goes down, we call that a debit. So, expenses are always debits. Just keep that in mind. Now, next, let's employ this terminology and see how we use it in analyzing financial transactions. Now, we have a ledger which is a record of all of our accounts, and we have various accounts, and we're going to use a tool called the T account. You see this, and it's a simplified version of the way we keep records in a real general ledger, and it works like this. For each account, we're going to put the debits on the left side and the credits on the right side. Simple as that. That sound familiar? Debits on the left, credits on the right. So let's take a simple example. Let's say I'm starting up a business and I'm going to do tax returns for my clients. And so first of all, I go to the bank and I borrow $1,000. They give me the $1,000. I deposit it in the company bank account. My business now has a asset, cash. Now, assets are debits, so I'm going to record that $1,000 on the left-hand side. I'm going to say debit cash $1,000. That's how we say it in accounting. Now, they didn't just give me that money for free. I had to sign a note. That's a legal document, right? That's a liability note payable. Now, liabilities are credits, right? So I'm going to record this $1,000 liability on the right side of this T account. Credit notes payable for $1,000. Okay. Now, let's say the next day some clients come in, I do their tax returns, I provide the work for them, and I hand them an invoice saying, you can pay me later, send me a check in the mail. And let's say I do a total of $5,000 worth of business. I have earned $5,000 of revenues. Remember, when I've done the work, I've performed the service, I've earned the revenues. Now remember, revenues are credits, always. So let's record those revenues. Credit revenues, $5,000, so I'm going to record it on the right-hand side, credits on the right. Now, I haven't received cash yet from my customers, but I have received another kind of asset, and that's what we call an accounts receivable, amounts that are owed to you from your customers. That's an asset. When assets go up, that's a debit, right? So I'm going to record the debit of $5,000 on the left side of the accounts receivable account. Now, let's say the next day, for some reason, I decide I would like to pay down the balance that I owe to the bank. I'll make a partial payment. I'm going to pay them $600 to reduce the amount that I owe them. I'm going to cut them a check, so my cash is going to go down. Now, when an asset goes down, that's a credit. So I'm going to credit cash for $600 on the right-hand side. And now, how does it affect notes payable? They're going down. When a liability goes down, that's a debit. So I'm going to debit notes payable $600. Okay. Now, let's say the next day I get a check in the mail from one of my customers for $2,000. I deposit it into the bank. So my cash account goes up. When an asset goes up, that's a debit. I'm going to debit cash for $2,000. Now, what other account is affected? Well, my accounts receivable now is going to be reduced because I've collected some of that. So when an asset goes down, that's a credit. I'm going to credit accounts receivable $2,000. Okay. Now, let's say it's the end of the month, we're going to close the books. What does that mean? That means we're going to calculate the ending balance in each one of our accounts. Let's see how it works for the T account. Let's look at cash. Okay? Now, we're going to take the total of the debits and the total of the credits, and we're going to net them together. Remember, to net together means to combine together. So, if I have 3,000 of debits and 600 of credits, that leaves me with a net debit balance of 2,400. So, because it's a debit balance, I'm going to show it on the left-hand side, a debit balance of 2,400. Let's look at accounts receivable. We've got debits of 5,000, credits of 2,000. When I net them together, what I get is a net debit balance of $3,000. Because it's a debit balance, I'm going to show it on the left side like that. Now, notes payable, let's take a look at that. We have $600 worth of debits. We have 1,000 of credits. So when I net them together, I get a net credit of $400. Because it's a credit, I'm going to show that on the right-hand side. And revenues is dead simple. Revenues are always credits, so I have a credit balance of $5,000. Now, let's stop here for a moment and think about the nature of these accounts. Cash is an asset. Remember, assets are debits, so this account has a debit balance. We expect our asset accounts to always have debit balances because assets are debits. Here's a liability account. Notice it has a credit balance. We expect our liability accounts to normally have credit balances because liabilities are defined as credits. Revenues are always credits, remember, and if we were to have expenses, we would always have debit balances there. And of course, if you have some equity accounts, they act like liabilities. You normally expect them to have credit balances. Now, let's take a look what happens at the end of the month if we add up all of our debits. We get $5,400 worth of debits. And what if we add up all of our credits? We get $5,400 worth of credits. Now, here's the key takeaway for today. For each and every transaction, the total debits will always equal the total credits. And within our entire accounting system as a whole, at every moment in time, the total debits will always equal to the total credits. Now that you've learned how we use these terms in accounting, let's get ready to use these terms to describe financial information. See you next time.